Welcome to OLevels Economics Unit 38 Foreign Exchange Rates. A foreign exchange rate tells us how much one currency is worth compared to another. For example, if $1 equals 65 Indian rupees, it means that $1 can buy 65 rupees. Exchange rates are very important because countries trade with each other using different currencies. There is also something called a foreign exchange rate index, which measures the value of a currency against a basket of other major currencies. These currencies are weighted according to their importance in international trade and financial transactions. There are two main types of exchange rate systems: fixed exchange rates and floating exchange rates. A fixed exchange rate is one where the government or central bank keeps the value of the currency fixed against another currency or group of currencies. To maintain this value, the central bank may buy or sell the currency or change interest rates. For example, if demand for a currency rises and its value starts increasing, the central bank may sell more of that currency to keep the exchange rate stable. If the government lowers the official value of a fixed exchange rate, it is called a devaluation. If it raises the value, it is known as a revaluation. In contrast, a floating exchange rate is determined entirely by market forces of demand and supply. If demand for a currency rises, its value appreciates, meaning it increases in price. If demand falls or supply rises, the currency depreciates, meaning its value falls. Under a floating system, exchange rates can change frequently depending on economic conditions and investor confidence. Currencies are traded in foreign exchange markets. The main participants in these markets are commercial banks, although governments, firms, and individuals also buy and sell currencies. Currencies are exchanged for several reasons, including buying exports and imports, investing abroad, purchasing financial assets, foreign direct investment, and speculation. Speculators play an important role because they buy or sell currencies based on what they think will happen to exchange rates in the future. The demand for a currency comes from foreigners wanting to buy goods and services from that country, foreign investors investing in businesses, people saving money in banks, and speculators expecting the currency to rise in value. For example, demand for Indian rupees would increase if foreign firms wanted to invest in India, or if foreigners bought Indian products. On the other hand, the supply of a currency comes from residents buying foreign goods and services, investing abroad, or exchanging money to travel or save overseas. Speculators may also sell a currency if they believe its value will fall. Interest rates can strongly influence exchange rates. If a country raises its interest rates, foreign investors may move money into that country to earn higher returns. This increases demand for the country's currency and raises its value. Higher interest rates often attract what economists call hot money flows, which are funds moving around the world in search of the best returns. Exchange rates fluctuate for several reasons. Changes in exports and imports can affect demand and supply for currencies. For example, if exports increase relative to imports, demand for the currency rises and its value tends to increase. Foreign direct investment can also strengthen a currency if multinational companies invest in the country. Speculation is another major factor because expectations about future exchange rates can influence current demand and supply. Governments and central banks may also intervene by buying or selling currencies or changing interest rates to influence exchange rates. Changes in exchange rates have important effects on exports and imports. If a country's currency appreciates, exports become more expensive for foreign buyers, while imports become cheaper for domestic consumers. For example, if the Indian rupee strengthens against the British pound, Indian products sold in the UK become more expensive, reducing export demand. At the same time, British imports become cheaper in India. The impact on export revenue depends on the price elasticity of demand. If demand is elastic, higher prices will reduce export revenue because consumers switch to cheaper alternatives. Exchange rate changes also affect the wider economy. A depreciation of the currency usually makes exports cheaper and imports more expensive, increasing demand for domestic products. This can raise economic growth and employment if the economy has unused resources. However, a weaker currency may also create inflationary pressure because imported raw materials and finished goods become more expensive. Higher import costs increase production costs and consumer prices, contributing to inflation. Floating exchange rates have both advantages and disadvantages. One advantage is that they can help correct imbalances between exports and imports automatically. If imports rise and exports fall, the currency may depreciate, making exports cheaper and imports more expensive. This can improve the trade balance over time. Floating exchange rates also allow governments to focus on other economic goals without constantly defending the exchange rate. However, floating rates can fluctuate significantly, creating uncertainty for firms involved in international trade. Sudden depreciations may also lead to inflation. Fixed exchange rates also have strengths and weaknesses. Their main advantage is stability and certainty. Businesses know the exact exchange rate they will use when trading internationally, making planning easier. However, maintaining a fixed exchange rate can be costly because central banks may need large reserves of foreign currency. Governments may also have to raise interest rates or use other policies that conflict with goals like reducing unemployment or encouraging economic growth. If a government fails to maintain the fixed rate, confidence in the economy may fall. Finally, the chapter discusses international competitiveness. A country is internationally competitive if it can produce goods and services that consumers want at acceptable prices. Indicators of competitiveness include economic growth, share of world trade, investment, research and development, education, training, and infrastructure. Exchange rates and inflation can affect competitiveness in the short run, but long term competitiveness depends more on productivity. Productivity can improve through investment, better education and training, technological progress, and improved working conditions. Countries with high productivity and efficient industries are more likely to compete successfully in international markets. Thanks for watching.